Hi, good morning clients. We are ready and about to start our morning webinar for today. For today, we are going to present on our initiation released last week on Dasin Retail Trust. And thereafter, we're going to have company updates on Rowsley, 800 Super and Cash Logistics. Hi, good morning everybody. Okay, I will start on Dasin Retail Trust first. This is an initiation we did last week. And before I go into the key investment thesis, in a nutshell, this trust, they own 4 retail malls in Zhongshan. So our investment thesis for this will be just purely organic growth over the next 3 years from FY17 to 19. We are expecting very healthy organic growth in the range of a CAGR of 16%. And on top of that, you're looking at a trust with a sponsor which is a market leader in Zhongshan itself, with a 40% market share in the total retail GFA in that city. So the parents ROFR pipeline for this trust actually will or could potentially quadruple the trust's assets. And then lastly, buying into Dasin Retail Trust is also tapping into Zhongshan's vibrant economy, which we will elaborate on later on as well. A brief overview of the company. This trust is backed by Zhongshan Dasin Real Estate Co. And this company is a leading developer of predominantly residential and retail properties in Zhongshan. And like I mentioned earlier on, they are one of the market leaders in if you talk about retail malls in Zhongshan, they are like the capital land of Zhongshan in retail malls, 40% market share. If you look at the 4 malls that the trust owns, is laid out, the details are laid out in the table below. So you see that there is actually quite a good mix of mature malls in terms of, you look at the first one, Xiaolan and Shiqi, they are about around slightly more than 10 years old, and you have 2 new malls as well in Ocean Metro and Dasin E-Color. And occupancy for these 4 malls has been at full occupancy at the last reporting quarter. In fact, they have been full for the past decade, which I'll elaborate on later on as well. And tenants, there is also, you can see a wide range of renowned international tenants as well. You have your McDonald's, your Nike, your Adidas, your Starbucks, etc. So for Dasin Retail Trust, I'll first talk about the lease structures. If you look at the lease structures on the left, they have a good mix of actually predominantly fixed rents with built-in annual escalations, and these annual escalations can range from 5% to 8%. That makes up the bulk of their leases, 57%, and then another 28% is either a higher of a base rent of a fixed base rent or higher of turnover rent. So the structure of these leases is such that they allow us a pretty good visibility and predictability of the organic growth that you can see going for the trust going forward, because you have it that bulk of the leases will be escalating at a fixed rate at a predetermined rate when you sign the leases at the start of the contract. And if you look at the tenant mix for the trust, they are predominantly focusing on necessity spending and lifestyle, the lifestyle sectors. So this is a table showing the comparison between the trade sectors in Dasin and CMT and CRCT. So you can see that actually in terms of the trade sectors which has a higher correlation with e-commerce, you see that fashion, they're actually not so much exposed to that sector, but in the IT electronics part, they do have a higher proportion of exposure. So we talked about buying into the trust as a form of a proxy to tap on the vibrant economy of Zhongshan. So we look at if you look at the blue table on the bottom left, you see that for GDP per capita for Zhongshan in the last decade, they have been growing at a very strong 9% CAGR. And that number has actually been tracking very closely to China's GDP as well, if you look at the chart on the left. And we believe that the implementation of the Shenzhen-Zhongshan Bridge going forward, this bridge is actually under construction right now. It is slated to complete in 2021. So this bridge, we think that it could be a big catalyst in spurring um population growth in Zhongshan, and this is a function because of, if you know, the price differential between Zhongshan and Shenzhen property prices. Shenzhen property prices, we all know, is notorious for being sky high, and right across the bridge in Zhongshan there is a big differential there. So with better connectivity between these two cities, there is a potential that people with traveling time between these two cities cut to half an hour, people could end up buying homes in Zhongshan and then working in Shenzhen. So with that kind of phenomenon playing out, you could see an increase in the population and an increase in the retail spending in Zhongshan. As for the retail scene in Zhongshan, it's actually a very is a the retail scene in Zhongshan is in the nascent state, and you see that for that city itself, the first shopping mall they have is actually pretty recent. It's just in 2004, and that mall is the Shiqi Metro Mall. This name may sound familiar because it is part of the four malls that the trust is holding. So the first mall is in 2004, as you can see. So this is a very new, is a sector that is very new and up and coming and growing. And if you look at the retail sales for the city itself in the past decade, they have been growing very strongly at 14% CAGR. So this is the Shiqi Metro Mall I was talking about, the first mall they had, which opened in 2004. So if you can look at the internal facade, it's actually quite a modern, trendy looking mall. And this is the as of for FY18 our forecasted revenue, this mall will actually contribute 35% to the total group revenue. Okay, and then one of the developments we believe that could happen is that there is very active involvement and a lot of initiatives by the local governments in developing the Pearl River Delta regions, and we believe that these developments in the area could actually potentially narrow the disparity between Hong Kong and Zhongshan rents, which, if you can tell from the table, they are poles apart right now. But so, and that actually points to the fact that there is a lot of room to grow for Zhongshan malls rents, and a lot of catch up to do. So for the healthy organic growth that formed part of our investment thesis, we forecasted a CAGR of 16% organic growth from FY17 to FY19, and this growth will primarily come from two main aspects. Firstly is the built-in rent escalation that we mentioned. Our forecasted numbers actually has inbuilt rent escalations of between 5 to 8%, and these are numbers which are clearly stated in the prospectus, and these are numbers which are already in current contracts. So 5 to 8% annual rental escalations, and then you have a second kicker in the rental reversions to the organic growth as well, because as we have mentioned earlier on, two of the malls are in up and coming regions. These are new malls, and as we all know, new malls typically rents are cheaper because as a landlord, you have a new mall, you try to get in tenants for the first phase of the lease. Typically, the tenants are charged cheaper rents for the first phase. So you have two factors in there. Firstly, rent escalations and then rental reversions. Added up together, these are expected to drive a 16% organic growth in in the 3 years going forward. So a brief overview of where the malls are located for the trust as well as for the parents referral pipeline. You can see in this map over here. And we talked about the pipeline of malls potentially quadrupling the trust's total GFA. This is what you can see here. Right now, you have it at 430,000 square meters, and that potentially could quadruple to 1,700. Sorry, that's 1.7 million square meters. In terms of the balance sheet and gearing for Dasin Retail Trust, this is currently geared at 31%, and this will imply a debt headroom of 210 million for the trust to deploy for further inorganic growth. And if you can see that in 2018 there is actually very little risk of refinancing for the trust, because there wouldn't be a lot of debt expiring in that year. So I guess a lot of top concern for investors when they look at Dasin will be how this trust would compare to CRCT, and already we are having questions coming in asking about how this trust compares with CRCT. So if you can look at the occupancy for Dasin and versus CRCT, you see that for Dasin they have been very stable at full occupancy over the last decade. And I guess the key difference for them is also that the profile of the malls that they have is a mixture of mature malls, which will give you stable income, whereby your rental reversions are more stable, and as well as a good mix of new malls in high growth regions as well. And these are the malls that will drive organic growth going forward. As for CRCT, their portfolio is more of a portfolio of more mature malls. You can see that the age of the malls is an average of close to 10 years or slightly more than 10 years. And I'm talking about these are the multi-tenanted malls for CRCT. So for our valuation model, we have used a discounted dividend model to arrive at our target price of 98 cents. This is a 4-year projection going forward from now until 2021 to account for the final year whereby the waiver distribution will end, and we have a terminal growth of 0%. If you look at the comparison chart below, you see that Dasin actually enjoys the highest yield amongst retail REITs listed locally. So what are the key risks for Dasin? The first will be the income support, as we all know, and I guess this will be the top concern for most investors as well. We all know that in this year, the sponsors waiver entitlement is for 54% of the total units, and this waiver entitlement will gradually taper off from FY17 to the end of FY21. So the steepest drop-off in the waiver expiry will occur in FY21, whereby you have a drop of from 35% of units not getting distributions in FY20 to this number dropping to 15% if in FY21. And this being the greatest uncertainty, or I guess the topmost concern for investors, and because it's a 4-year forward projection, so a lot of uncertainties within the next 4 years could occur in terms of whether the earnings can keep up, rental reversions can keep up, rental escalations can keep up to offset the drop-off in the waivers. So this will be one of the key barrier to otherwise what would have been an even more conviction call from us. And the second risk for Dasin is the exposure to RMB, similar to what CRCT has. they are exposed to RMB FX without having done any FX hedging. And these are some of the pictures you can see for what is happening on the ground. We see a lot of vibrancy in the some of the key supermarkets, your F&B outlets. You see that this is the crowd that they're seeing on a weekday afternoon in the supermarket. And similarly, this is for a weekday noon crowd as well. You see that close to 70% of the tables are occupied. And this, the average spending for people in this restaurant, they are about close to Sing dollars 30 plus dollars per pax. And this will showcase some of the events that the operator hosts to draw in crowds. You see that they have various innovative ways, like for example at the rooftop of some of the malls, they have this farming plots whereby they hold horticulture events where kids can come on and take on like some of the plots to grow their own plants, and they even have malls with theme parks at the rooftops. This is part of the referral pipeline for the trust. This is Shiqi Mall number 2, and that mall actually saw the parent partnering several renowned fashion brands, international fashion brands for the first time, and including H&M, including the likes of Uniqlo. So with that, I'll pass on to Paul for Rowsley. And just before we carry on, just to elaborate, the Dasin initiation that we just elaborated on is actually a StockFacts paid research program collaboration between the two companies.
Okay, thanks, Dehong. This is Paul here from Research Department. Just wanted to there's no report on Rowsley, but they did make analyst briefing last Monday. So just wanted to give you some key highlights on Rowsley. Okay, this is a very noisy slide. Basically, we have valuations and the transaction, but just give you the basic transaction. What has happened is that Rowsley will be acquiring, if you turn on the next slide, Thomson Medical Center and also the listed Thomson Life Science. So Thomson Medical Center, as you know, is in operation. And TMC Life Science owns a hospital in Klang Valley, Kota Damansara, and there's a greenfield hospital by 2021. Okay, anyway, the key points of the transaction is that they will be acquiring a company, as you can see here, Sastria. Sastria is actually owned by Peter Lim, we call it the vendor. So, but to acquire this, Rowsley will be issuing 21.3 billion new shares at the price of 7.5 cents. So the existing number of shares of Rowsley, from, as you can see from the chart, 4.7 billion, it will rise by another 21.3 to 26.1. There are other parts of it which I won't go too detailed, just not to complicate the thing, but there will be bonus warrants and also piggyback warrants on top of the bonus warrants. But anyway, just three things we wanted to highlight about this transaction. As you can see, our observations, number one would be the valuation. As you can see, they're acquiring Sastria for 50 times PE, or sorry, 48.8. And if you compare this with some of the existing players such as Raffles Medical, is 27 times PE, and also at almost a 6 times price to book. That's the first thing. So the valuations appear to be rich. The second and more important and more pertinent thing is that there is going to be a compliance placement. As you can see, post acquisition, the vendor will own 90% stake in Rowsley. So as a result, there are plans to undergo a a compliance placement. So if you assume 5% compliance placement, this is almost 1.3 billion new shares. And because the vendor has got these shares at 7.5 cents, we just think that whoever holds Rowsley shares now, trading now, I think around 13 cents, will be very exposed to this huge block of shares at 7.5 cents. So that's our the key second observation from this transaction. The third observation will be, as you know, these are greenfield. If you look at the next slide, there's going to be a greenfield hospital, Thomson Medical Hub, and as you know, most greenfield hospitals will incur losses in the first 1 to 3 years. So these are, in summary, these are the key things that we wanted to highlight to investors. And more important is the huge block of shares that's coming out at 7.5 cents, which is much lower, obviously, compared to the current share price. So investors or whoever holds Rowsley shares are pretty exposed to this, especially the compliance placement part. And if you assume, just one last point, and if you assume the shares stay at 13 cents, you are technically buying Sastria or all these assets at not 50 times, but maybe 80 to 90 times PE. Okay, that's it from us on Rowsley. Move on to Richard on 800 Super results.
Thank you, Paul. Yeah, we'll move on to results. So last week, we have an update for 800 Super. Last week we published a report following their announcement of the contract win. We downgraded the stock to accumulate from buy because of the favorable price movement since our last report. Target price is 140. We are forecasting a dividend of 4 cents. That will give you a 3.3% yield over the last close price on Friday, which is 120. So as I mentioned, the company had announced their contract win for the Pasir Ris Bedok sector. This is the amalgamation of the Pasir Ris, Tampines and Bedok sectors, and the contract is for 193.5 million, and this is for a tenure of 7 years and 4 months, effective from 1st July 2018 to 2025. We will see this contribution coming in their FY19 because their FY ends in June. Through this contract win, they have gained market share in public waste collection. They have dislodged the incumbents. Viola is the incumbent at Pasir Ris Tampines, and Sam Waste is the incumbent at Bedok. I've already talked about this bullet point where revenue and earnings will increase from FY19 onwards, where they will have a full year recognition for this contract. They have tendered the lowest bid, and this is likely at the expense of some margin compression relative to the other existing contract for the Ang Mo Kio Toa Payoh sector. Their ongoing contract was awarded at a value of 160 million, and that's for 7 years and 9 months. So this new Pasir Ris Bedok contract is, in terms of dollar value, is only 20% more, and in terms of tenure is comparable, it's 7+ years, but there's approximately double the number of households in this new sector, so they are having to do quite a lot more work, and revenue is only 20% more. So probably margins for this contract will not be as good as the existing Ang Mo Kio Toa Payoh contract. There will be some impact in FY18 before this contract starts. We expect to see higher interest expense and a negative free cash flow due to the startup capex. So we've assumed 30 million for capex for the vehicles, bins and containers, and our assumption is for a 20-80 mix, 20 equity, 80 debt to fund this capex. So that's where the higher interest expense will come from. Now we move on to cash, which announced their results last week on Thursday after the market. We have upgraded it to accumulate from neutral, higher target price as well of 92 cents. DPU, forecasted DPU is 6.05 cents. That will give you almost a 7% yield based on last close price of 88 cents on Friday. So for full year results, gross revenue is flat. There's contribution from the 51 Alps Avenue rental top-up. 51 Alps Avenue is the property where they had their tenant dispute with Schenker. That dispute has been amicably resolved, and they will receive a rental top-up to market rate rent. So in that sense, unit holders will not be disadvantaged from that dispute, and the outcome does not negatively impact unit holders at all. There was some higher revenue from a few other properties in their Australia portfolio, and offset by the divestment of Cash Changi District Centre 3 in January 2017. Distributable income is lower, almost 5% year on year. There's some differences in the composition of their distributable income between 2016 and 2017. 2017 there was the capital distribution in 2017 is 1.6 million, and that's lower than last year's FY16 2.4 million. This capital distribution is from the divestment proceeds of Kim Heng warehouse. Operationally, distributor income from 2017 is 64 million versus 66.9 million in FY16. DPU is double digit lower, almost 15% lower year on year. That's the effect of the rights issue that was completed in the fourth quarter of FY17. So now the current gearing is much lower at 36.3%. That's as a result of using the rights issue to pay back debt and lower the gearing from 43.6%. Also, in conjunction with the results, they announced the proposed divestment of 40 Alps Avenue, and this property is encumbered, so after the divestment is complete, they will use the divestment proceeds to repay debt as well, and that would bring their gearing even lower to 32.4%. Some of the negatives that occurred with these results is that they had almost a 32 million fair value loss on their investment properties, and consequently NAV dropped quarter on quarter from 77 cents to 72 cents. For the Singapore portfolio, the valuers had used a lower spot rent assumption, and also property value was impacted by shorter land tenure. Over for their Australia portfolio, cap rate had compressed, and that resulted in some modest appreciation in their Australia portfolio. Reversions were negative for the fourth quarter and as well for full year. Fourth quarter negative reversions of 3.7%, and full year was negative 6.7%. The manager is expecting rental reversions to continue being in negative territory in 2018 due to the ongoing oversupply situation. We have stated a stable outlook for cash. That's because of a combination of some negative and some positive circumstances. So negative wise is the soft market, that's the oversupply of warehouse space. Also from a bottom-up perspective, there should be at least 2 more quarters of year-on-year lower DPU. That's because of the effect of the rights issue and the dilutive effect. In terms of gross revenue, that's also going to be lower for FY18 compared to FY17. That's because of the divestment of 40 Elms Avenue. And the other issue that they need to tackle in FY18 is the master lease expiry of CWT Commodity Hub. The overarching positive for cash now is their successful recapitalization of the balance sheet. So as I mentioned earlier, the gearing is now much lower at 36.3 and is the potential to be further reduced to 32.4% once they divest 40 Elms Avenue and repay the debt. That will give them a headroom of almost 270 million, and that will be the ammunition that the manager needs in order to execute his strategy of acquiring in Australia. Okay, we've come to the end of today's webinar. We'll pause now for questions.
Hi, there's a question on the impact for Dasin's DPU if we were to strip out the waivers from the sponsor. What would the DPU be like? So if okay for FY17 there's 54% of total units that are not entitled to distributions. If you take that out, then the distribution DPU will be 3.9 cents. And then over the next few years for FY18 to FY 2021 will be the last year whereby there is a waiver there's a waiver of the distribution. So this year FY17 it will drop to 3.9, and then FY18 to FY 2021 the DPU range will be between 5 cents and 6.5 cents. And I think for investors concern is that how is income going to support or keep up as these waiver distributions get lesser and lesser. I think one thing to note is also that if you look at these two malls, the Ocean Metro Mall and eColor, they are in regions which are currently being developed and up and coming. Like for instance, Ocean Metro Mall. This is in a region that is slated by the local government to be the next commercial city center. So as with if you look at the last the previous mall, the first mall that they had in Shiqi, that mall was also in a similar situation, in an upcoming area, and the rents were gradually going up because the surrounding area was gradually being developed. So that whole process actually took close to 7 years for Shiqi to actually become mature and for rents to stabilize. So if you were to foresee a similar situation for Ocean Metro Mall, you are looking at a gradual step up in this mall that can actually support the drop off in the waiver distributions. And I guess a lot of this is well timed as well, because if you look at 2021, there is actually quite substantial amount of leases for renewal for this like for instance for Ocean Metro Mall and for eColor in regions which are still being developed. So there is this potential for rental reversions uplift in 2021 as well. And to add on, I guess one of the reasons why this whole waiver income distribution is structured in this way is precisely because that these malls are still in the process of ramping up rents. And then so what is important is that as these waiver distributions fall off, the step ups or the increase in the rents can actually keep up. And I guess that is in the mind of the sponsor as well, as they've structured the waiver in this way. And if you look at 2021, the amount of rental renewals that can potentially provide the uplift.
Okay, hi, this is Paul here. We've got a question. What would your advice for Rowsley shareholders in view of the acquisition? Because we don't have an official recommendation, but just to get back to as per our presentation, basically the acquisition is expensive relative to current peers, and like we mentioned earlier, whoever holds Rowsley shares now, you are exposed to a large block of shares. Large is probably understatement, but a huge block of shares that has been placed out at 7.5 cents. So whoever holds it now, you have to be wary of this huge block, especially when there's a need to do a compliance placement. Yeah, hope that answers it. Yeah, thank you. Yeah, give us a minute. We're looking through all the questions. There are quite a number. Thank you.
Okay, there's another question on the impact of e-commerce on these Chinese malls. How much of an impact will it have on Dasin? So I think the common theme for all these retail landlords is that there is a huge wave of e-commerce threat coming online, and then but if you look at some of the malls that Dasin has, for example, in Shiqi, there is a conscious effort to move towards the experiential shopping kind of tenants. So and as well as the necessity spending kind of tenants. And if you look at, for example, when the mall just started, it was just 10% of the gross rental income that was allocated to the necessity spending sector, and then right now it's gradually moving towards the 30% mark. And a lot of it has got to do with how you attract the footfall into the malls as well. If you look at some of the pictures we posted up, you look at for instance, these central atriums are where they will hold with various events, such as they have the transformer events, car shows, motor shows, and they also utilize the rooftop space to hold for instance the horticulture events, which we saw a huge turnout in the pictures. And then as well as some of the malls we saw, there were theme parks on the rooftops as well. So, and I think in Zhongshan itself, I from what we observed on the ground when we were there, I think the state of e-commerce, like for instance in the likes of the equivalent of Uber Eats, right, in the Baidu Waimai in over there. In that few days we were there, there were actually not many of that kind of drivers you see riding around, as compared to if you go around the streets over here, you see lots of Uber Eats drivers, lots of food panda kind of riders. But over there, I guess what we feel on the ground is that is not as rampant, that the how widespread e-commerce is still not as rampant in Zhongshan. And Furthermore, we looked at some of the stats for Zhongshan. You're actually backed by strong GDP per capita growth in terms of the increase in the spending power of consumers, and then you look at the strong retail trends as well. The CAGR of 14% for retail sales in Zhongshan itself. So I guess you're actually backed by very solid fundamental strength in the economy itself. There is also another question on the comparison for Dasin versus BHG REIT. So first off, the geographies that these two REITs are in are very different. For BHG, they are actually 60% of their rental income comes from a mall in Beijing, and within Beijing itself is also so huge. There are different dynamics for different malls. But that being said, they have they have a strong mall in Beijing, but also they have malls in Chengdu, in Hefei. So these different dynamics within these different cities have to be considered as well. But what is important is that for Dasin, right, they are actually supported by this strong potential in Zhongshan in terms of the developments in the PRD region, in terms of the upcoming Shenzhen-Zhongshan bridge that can potentially spur the population growth, retail consumption spending, and then you look at the GDP per capita as well. So um, so right now you're having a close to 10% yield for Dasin, and versus BSG is doing right now just close to 7.5%. And I believe the gearing for Dasin is slightly lower as well. If there are no further questions, we will end today's webinar. Thank you all for attending, and we look forward to seeing you guys again next week.